Investors, including Michael Burry, placing millions of put contracts against Cathie Wood's ARK Innovation ETF. She hit back, said Burry doesn't understand the explosive growth in innovation investing right now.
Many investors, I'm sure, think, okay, well, we've seen the destruction there. We think it's just begun. A lot of industries are in harm's way. I don't think the market's ready for this. We've never been at a more provocative time for innovation in history.
Whether you're a fan of ARK Invest's thematic funds focusing on disruptive innovation, or you're somebody who tracks the moves of incredible value investors like Warren Buffett, you're probably aware of the ongoing clash between Michael Burry and Cathie Wood. In case you're not, here's the short and sweet version. Earlier this summer, Michael Burry tweeted that we are in the greatest speculative bubble of all time in all things by 2 orders of magnitude. If true, that would be quite the bummer. Around that time, the SEC filings of Burry's hedge fund, Scion Asset Management, revealed that he has a $530 million bet against Tesla. Tesla is, of course, Cathie Wood's largest position in 3 separate ARK Invest funds and is ARK Invest's biggest investment overall. Cathie Wood has over $3 billion in Tesla. The latest SEC filings for Scion Asset Management revealed that Michael Burry now also has $30 million in put options betting directly against ARKK, ARK Invest's massive flagship innovation fund. He also increased his short position on Tesla to over $700 million. Cathie Wood responded to that with a series of tweets addressing inflation versus deflation, bubbles versus strong markets, and growth opportunities versus value traps, ending her Twitter thread with this. To his credit, Michael Burry has made a great call based on the fundamentals and recognized the calamity brewing in the housing and mortgage market. I do not believe that he understands the fundamentals that are creating explosive growth and investment opportunities in the innovation space. It's easy to take everything I just shared with you and run with the narrative of bear versus bull, value versus speculation, inflation versus deflation, bubble versus real exponential growth. The truth is, this is a battle of short-term versus long-term, and in my opinion, all of those other arguments just boil down to symptoms of the timeframes that Michael Burry and Cathie Wood are operating in. Let me explain. It's currently September 2021, and unless Michael Burry has access to special options, his options will expire in less than 2 years from now, even sooner for some of his earlier options contracts. Over $500 million of his $700 million bet against Tesla was made in the first quarter of this year, when Tesla was trading close to $900 per share after rallying something like 800%. It wouldn't be surprising to find out that Michael Burry is already in the money with his short position on Tesla, just like it wouldn't be surprising that Cathie Wood will continue to make a lot of money on her long position on Tesla over the next 5 years. In my opinion, Tesla is fundamentally misunderstood because it spans many different market sectors, industries, and technologies ranging from artificial intelligence and robotics to energy generation and storage. That's why so much of my content focuses on the science and engineering going on at Tesla. The way I see it, ARK Invest focuses on making long-term gains by understanding technologies that most of the market doesn't, while Michael Burry focuses on making shorter-term gains directly from these misunderstandings themselves by making big bets when a company's valuation doesn't align with its balance sheet one way or the other. Here's the issue. When 1 or 2 balance sheets look bad compared to their valuations, you can write it off as those specific companies being too richly valued. That explains Burry's short position on Tesla. His short position against ARKK is far more interesting because when every company's balance sheet starts to look bad to you, you're forced into one of 2 positions. The short-term position that we must be in the greatest speculative bubble of all time in all things by 2 orders of magnitude, or the long-term position that technology and innovation are somehow allowing newer companies and markets to scale much faster than they used to, justifying at least some of these higher multiples. Now that we've reframed the debate as short-term versus long-term, here's a quick clip from Cathie Wood's recent interview on CNBC's Tech Check, where she explains this exact phenomenon and how it's actually good for her strategy.
Hedge funds jumping ship, investors, including Michael Burry, placing millions of put contracts against Cathie Wood's ARK Innovation ETF. The fund grew a whopping 149% in 2020. This year down just about 6%. She hit back, said Burry doesn't understand the explosive growth in innovation investing right now. ARK Invest founder and CEO Cathie Wood joins us here on Tech Chat this morning. Cathie, always good to have you. Thanks for the time.
Thank you for inviting me, Carl. Always happy to be here.
So let's talk about the short community at large. What is your message to them right now?
Well, you know what? When I see such negative sentiment out there, especially when it comes to valuation and longer time horizons, investment time horizons, I actually feel a little more comfortable. I like bad news. The discounting is worse now than the news actually will be. I actually feel better in that kind of environment for our strategies. I don't think we're in a bubble, which is what I think many bears think we are. In a bubble, and I remember the late 90s, our strategy would have been cheered on, rah, 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 go get them, right? And you remember the leapfrogging of analysts making estimates, one higher than the other, price targets one higher than the other. We have nothing like that right now. In fact, you see a lot of IPOs or SPACs coming out and falling to earth. We couldn't be further away from a bubble. And the reason for that is the innovation around which we have centered our research. These 5 platforms, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, are barely off the ground. The seeds for all of these platforms were planted in the 20 years that ended in the tech and telecom bust. And ended in tears. And there's a lot of muscle memory around that. But that's not what's going on right now. The seeds planted back then are beginning to flourish now. And it's just beginning with 5 platforms involving 14 different technologies, all of which are about to experience S-curves and feed one another's S-curves. I don't think the market's ready for this. We've never been at a more provocative time for innovation in history.
So it's obvious to Cathie Wood that we're not in a bubble because bubbles show certain signs and patterns that we're not seeing in the market today, like extreme bullishness and high momentum across the board. If we take a look at the American Association of Individual Investors and their sentiment survey, we can see that bullishness is at 43.4%. A little higher than the historical average of 38%, but a far cry away from even the one-year bullish high of 57% that we saw this past spring, or the over 70% bullishness before the dot-com bust 20 years ago. Also, 1/3 of all surveyed market participants are bearish right now, which is slightly higher than the historical average. If it were a bubble, I'd expect the bear to bull ratio to be a lot more, well, bullish. All of this negative sentiment is actually great for Cathie Wood's strategy because she actively trades into the stocks she feels are getting discounted way more than they should be. People who think that ARK Invest is somehow stuck in one position or another aren't paying attention to the holdings inside these funds. They shift all the time. Earlier this summer, I made multiple episodes highlighting Cathie Wood's massive moves away from genomic stocks and into deeply discounted web technology stocks inside ARKK specifically. Cathie Wood loaded up on stocks like Twilio, Coinbase, Twitter, Palantir, UiPath, and Unity Software. Since then, ARKK is up over 25%, and many of the stocks inside this fund are up by way more than that. Michael Burry is an incredibly smart investor, so he'd be crazy to bet against Cathie Wood as a stock picker. So the question we should be asking is, what is he actually betting against with his short position against ARKK, and why?
But as far as the shorts go, in terms of how they have their eyes set on ARK specifically, is it just, do you think, is it general macro bearishness, or does it have something more to do with your ability to analyze all these companies that you're now in and stay on top of that game?
I actually think it's more of a macro call. When I read the bearish analyses, they seem to be centered on inflation and interest rates going higher, which will kill valuations. And if anything, as you mentioned, Carl, we're focused on the deflationary forces that are building up in the economy. And I think that's going to be the shocker out there, that deflation is the greater risk now, not inflation. And I'll give you the easiest example. Last year, EV sales were 2.2 million units around the world. We think, based on the declining costs of battery pack systems, that electric vehicle prices will drop below gas-powered prices in a year or so. They're already lower from a total cost of ownership point of view. So we think that 2.2 million will be 40 million in 5 years, in 2025, not even 5 years. No one is forecasting that. So the starting point from the top down, using Wright's law, getting a sense of how quickly the costs associated with these technologies are falling, and how quickly, therefore, they will be taken up by more and more sectors and industries over time.
Yeah, just listen to the language here. Wright's law, declining production costs, projections of demand. The truth is that these two investors are not fighting because they're not even speaking the same language. Michael Burry is treating ARKK like an index of stocks that's very sensitive to inflation and rising interest rates. He's betting that as inflation will go up in the short term, the value of this particular basket of stocks will go down in the short term. Cathie Wood is saying that deflationary forces are going to outweigh inflation over the long term, and in some cases, like the cost declines associated with electric vehicles, sooner than we expect. And again, if you recognize their different time horizons, Michael Burry and Cathie Wood can both be right. Let's start with inflation. During the height of the pandemic, people were stuck inside, so they were working on their homes and stocking up on stuff. That caused businesses to double and triple order inventories, causing a lack of supply. As a result, we saw the cost of household goods and commodities like lumber go way up. Lumber is already down by 2/3 from its highs in early May. That inflation had two properties. It was focused on goods specifically, since that's where people were pouring their money into instead of services and experiences, and it was temporary, because services and experiences won't be shut down forever. Now, the opposite is true. As services and experiences come back into the mix, they'll be able to charge more because there's a lot of pent-up demand and limited capacity. Traveling, going out to shows, and so on will all cost more than they did pre-pandemic until this pent-up demand is satisfied. So again, there is price inflation, but it's narrowly focused, near-term, and temporary. Now let's talk about the deflationary forces. I actually already covered the first one, which is the price of stuff coming down as pent-up demand gets filled. The second type of deflation is actually good deflation, which is technology getting cheaper to produce thanks to Wright's law. If you want to learn all about Wright's law, you can check out one of my very first episodes where I lay out exactly how it works. And each one of these dots represents the state-of-the-art integrated circuit and its part count. The line represents Moore's law. The channel has come a long way, but if you want to check out that episode, I'll link it in the top right-hand corner of your screen right now, and in the description below as well. It's a real nail-biter. The effects of Wright's law and good deflation can be felt everywhere. Think about the first iPhone versus the iPhone today, or the first laptop versus laptops today. This is the same type of good deflation that's responsible for electric vehicles getting cheaper as the costs of batteries and industrial robots and so on continue to go down. That lets these innovative companies produce even more of their products and services, which lowers the cost, which increases demand, which results in more production, and that virtuous cycle goes on and on. When Cathie Wood talks about wanting companies to spend money today to dominate these winner-take-most markets in the long term, she's talking about them investing in this cycle of lowering costs to greatly increase demand to the point where entire markets and ecosystems are built on top of their platforms. The final type of deflation is called creative destruction, which is a creative way of saying that non-innovative companies are going to get destructed because they can't deliver the same performance at the same price point. Again, let's think about electric vehicles in general and Tesla specifically. The Tesla Model S Plaid is the current record holder for accelerating from 0 to 60 miles per hour, which it does in just under 2 seconds. It also costs a fraction of the price of most cars on this list, and as you can see, more and more cars near the top of this list are all electric and dual motor. So if you're building a car that's on a different platform, say an internal combustion engine, and that platform can't compete in performance, what do? You cut your prices, and that's permanent, not temporary, because it creates a vicious cycle where lower prices means less profit, means less production and investment in innovation, which means less performance improvement over time, which means lowering prices again, and so on. Winners keep extending their lead and losers keep losing ground over time. That's creative destruction, also known as bad deflation. So how is it that ARK Invest has figured this out? Here's a clip of Cathie Wood putting it all together.
What does someone shorting ARK miss about your approach, the advantages or perhaps the differences of being an ETF versus, say, a hedge fund?
I don't think the wrapper matters that much. I think our research is the differentiator. And the way we've set up our research department is a differentiator. Unlike traditional asset management firms, our analysts do not follow sectors. They follow technologies, the 14 different technologies that I mentioned involved in these 5 major innovation platforms. So they are technology specialists, and they are generalists when it comes to sectors. So we have a very good idea based on our analysis of these technologies and Wright's Law. Wright's Law, we've centered our research around it. So we think that's a very important gauge of how quickly these costs are going to decline over time. And we also pay a lot of attention to price elasticity of demand. At what point in this cost or price decline trajectory will new sectors open up to these new technologies? And so I think what we are able to see is our exponential growth trends that are not priced into the market. If when we look at the S&P 500, for example, we think that because of technology changes and importantly, that a lot of industries are in harm's way. Energy certainly is. Because of electric vehicles and the move towards autonomous electric. And you can throw in autos and the auto supply chain. They're scrambling to try and get into this new world. It's going to be very difficult. Even when you think of retail, many investors, I'm sure, think, okay, well, we've seen the destruction there. We think it's just begun in a way because online retail sales have only hit 20% of total sales here in the United States. When a trend moves from 10 through 20%, it's usually moving into overdrive. So we think a much higher percentage of sales will be online. So even retail and any business that can be done online. Financial services, I would say digital wallets, DeFi, a big problem, a big challenge for financial services.
Wright's Law, cost decline trajectories, price elasticity of demand, trends crossing the tipping point. I'm not saying that Cathie Wood is smarter than Michael Burry, or that ARK Invest is somehow better than Scion Asset Management. What I am saying is that Cathie Wood set up ARK Invest to understand the market from a completely different perspective than traditional asset managers, technology platforms, not just earnings reports. The truth is, if you stop worrying about the average PE ratio of the companies inside the S&P 500 and start researching the remarkable pace of innovation, you'll see that the real risk is investing in companies that are getting left behind. This is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.